Alright, you guys, my name is Charles, and this is the Trader Score, and today we're going to be following on in a series where we're talking about basically things that you might not know about trading, right? Very simple things, very simple words that you might hear all the time that you might not know, and you might say to yourself, well, I don't really want to ask anybody because, I feel like I should know that, right? Maybe you have a sense of, you understand what people might be doing, but you don't understand all the jargon, right? Which is a very much a place where I was at in my own trading, and kind of getting started in the finance field in particular, right? And that's kind of the point of the series, is to kind of demystify, some words, some jargon that you might hear. So it's a little bit simpler if you're not new to trading. If you've had some experience trading, probably just skip over this series just because it's going to be getting at some people who are a bit newer to the market, and that's kind of the target audience with it. But if you want to talk more about trading, want to talk more about investing, you're around people who do it and you find yourself lost and kind of just not understanding what it is that they talk about, this is going to be a good series for you. So in this video, in this iteration of the series, what we're going to be talking about is the idea of going long versus short, right? Now this is a very basic concept when it comes to trading or investing, and it's one that you really have to understand, because you want to understand not just saying, oh, I'm long this, I'm short that, but understand what it is that you're saying when you say that, right? And basically what you're saying when you say I'm short is you have sold, or you are, I guess you would say, quote unquote, bearish, right? So what does bearish mean? You think that whatever security you're looking at is going to move more to the downside than it will to the upside, in whatever time horizon you're thinking about, right? This might be 5 years, this might be a year, this might be a month, it might be a week, right? You can express, opinions on the market in whatever time frame you choose. It might be within the next 5 minutes, right? Or whatever time horizon you choose, right? But that being said, if you're short a security, that means that you want to sell said security, or not own said security because you think that the price will decrease in the future. Whereas if you are a long security, it's the complete opposite, where you want to buy, or you have bought said security because you think the price will increase in the future, right? So again, whatever time horizon you give that, you think the price is going to go up more than it will go down, right? So that being said, obviously with each security, or each type of security that there is, and we're talking about different security classes, right, where we have things like option, or different asset classes, where we have things like options, futures, stocks, right? Going long and short means different things for different, I guess you would say, asset classes, right? But just to kind of get at some of the big ones very quickly here, we'll talk about options, futures, equities, and then we'll talk about Forex, all right? So first and foremost, with options and futures, if you go short a contract, which is what you're trading when you trade futures and options, you don't trade an actual underlying security, because a future and an option are both what are called derivatives. If you want to know more about what your security is called, check out our securities video. But what securities are, check out our securities video. But options and futures are derivative contracts, and they're generally derivatives of things like commodities or stocks themselves, right? And so that being said, when you go short an option or a future, you are going short the contract of that option and future. And essentially what you are selling, or what you're giving up, or what you're giving to somebody, is the right to buy, or maybe even sell, depending on what you're shorting when it comes to options. But it's the right to do something with the security in the future. You are giving that to somebody else, right? So let's say, just for ease of explanation's sake, you are shorting a call. Essentially what you're doing is you're selling somebody else the right to buy a stock from you in the future at a given price. Now it's a call option, right? Now you might also say short a future, right? If you short a future, it's much the same thing. You are essentially selling somebody the right to buy something from you in the future, right? And essentially the only difference between a future and an option when it comes to both going long and shorting is essentially just understanding that when you go long or short the contract, what you're going long or short is, with the option you're shorting the right but not the obligation, or you're going long the right but not the obligation, whereas with a future you're shorting or going long an obligation. So you have to do that thing, right? You have to buy whatever asset come time, right? If you're still holding that contract at the time of expiration. So that is the idea of going short a future and option. Whereas with the stock, what you do when you go short a stock is essentially you are borrowing that stock from your broker, and then you will buy that stock back in the live markets at some time in the future and return that stock to your broker, right? So you hope that you short the stock. When you borrow it from your broker, you're able to buy it back at a lower price, right? And then your broker will allow you to keep the difference of you shorting the stock at one price and then buying it back at a lower price, which is why you win when the price goes down when you short a stock, right? So that's the idea of shorting a stock. It can be a very complex process when you get into the inner workings of it, but from a 30,000 feet view, it's a very basic process of essentially just think about you're taking a loan of stock out from your broker. So essentially, if you take a loan from the bank to buy a house, what do you want that house to do? You want it to appreciate in value. Just think about it in a different sense in terms of if you take a loan out from your broker for stock, what do you want it to do? You actually want it to depreciate in value, right? Now, talking about going short a Forex pair, now this is a bit different because you're not actually shorting what's called a security, but you're actually shorting interest rates or rates, right? And essentially what you're doing is you are shorting one pair's rates while simultaneously going long another pair's rates. So you are, confident on one end, and then you're confident about a decrease in price on one end, and then you're also confident in an increase in price on another end, right? And so that's understanding shorting a Forex pair, right? Now, going long, that's why I started with shorting. Going long is a bit more easy to understand. So essentially, again, if we talk about options and futures, all you're doing is you're buying the right or obligation to buy something in the future at a given price. Again, buying stock, all you're doing is buying the ownership in a company, right? Whereas, again, buying a Forex pair, much like shorting the Forex pair, all you're doing is you're simultaneously expressing confidence in the increase of one currency's interest rates, or I guess you would say value, right? Versus the simultaneous decrease of another country's another country's currency's value, right? So that's kind of understanding what going long and short is, because understanding that, it's important to understand, because when people are talking about their views in the market, they might say, well, at this point I'm bearish, I'm short this, I'm short that, I'm short this, right? And basically what they're saying is, when they say that, is they're saying that they don't have confidence in its price increasing in the future. What they have confidence in is its price decreasing. Whereas again, vice versa, if you're long something, you have confidence in the price increasing. Now, you might find when you get into trading and investing, you kind of gravitate more towards one or the other. Something that I've really found in my trading specifically, not so much my investing, but my trading, is I tend to spot shorts better than I spot longs. I don't know why. Maybe it's just kind of my mindset. Maybe I'm a pessimistic person at heart. Right? It's kind of hard to explain, but it's a very common phenomenon that a lot of traders who have kind of been in the space for a little bit will kind of admit to, whether they admit it or not. And there's nothing wrong with it, right? I think as long as it works for you, it's fine, right? And as long as the shorting works for me and I'm not shorting things that put me in danger, it's fine, right? So that is understanding going long versus short. I hope you guys enjoyed that. Hope it provides some value, and please join us again next time, man. Thank you.